Welcome to Acquisition Playbook, how capital sources impact a company's acquisition strategy. This session is presented by S&T Bank and RKL. Let's meet our panelists. First, meet Steve Kindler Jr., President and CEO, National Fitness Partners, Planet Fitness. Next, meet Phil Brankel, CFO, West Shore Home. Welcome Sal Baccio, COO, HB Global, LLC, Commercial Services and Construction. Meet Ryan Hurst, Partner, RKL. And your moderator is Rich Beatty, Senior Vice President, Commercial Banking, S&T Bank. Rich, take it away.
Well, thanks to our host for the quick introduction on the folks to the panel this morning. As highlighted, our panel is focused on how capital sources impact a company's acquisition strategy. My name is Rich Beatty. I oversee the commercial lending activities for S&T Bank in Eastern Pennsylvania, and I'll be moderating the panel this morning. And joining me are Phil Brankel from West Shore Homes, Sal Baccio from HB Global, Steve Kindler from National Fitness Partners, and Ryan Hurst from RKL. If you guys are ready to have a little bit of fun, we can go ahead and kick this off with introductions on your roles, backgrounds of yourself and the company that each of you are with, and we'll dive right in. So with that, we'll start with Phil Brankel.
Thanks, Rich. My name's Phil Brankel. I'm the Chief Financial Officer here at West Shore Home. I really serve as a strategic CFO. I'm very lucky to have a Chief Accounting Officer that really oversees the accounting aspect of our business. So I'm really focused on capital structuring, mergers and acquisitions, supply chain, fleet, facilities, kind of all the strategic operational finance in the company, with obviously today's focus being M&A. So happy to be part of the crew. And prior to this, I had a 18-year career in commercial and corporate banking, working for some large corporate banks throughout the nation. So also understand capital structuring pretty well. So look forward to being part of the panel.
Thanks, Phil. Really jealous you figured out how to get out of banking. With that, I'll turn it over to Steve Kindler.
Perfect. Banking is one thing I will never get into. My name is Steve Kindler. I'm President and CEO of National Fitness Partners. We are one of the largest Planet Fitness franchisees in the nation. My family has been in the fitness industry since the early 1960s, and have run every type of model known to man inside of the industry, and have been a very fortunate and blessed Planet Fitness franchisee for the last 15 years. We have grown exponentially over the last 4. We currently have 78 locations in 4 states, and have a runway to go build another 35 plus locations in those markets. And really fortunate to be able to share our experience with the different M&A activities that we've done to date.
Thanks, Steve. We'll move on to Sal.
Hey, thanks, Rich. So Sal Baccio, I'm the Chief Operating Officer for HB Global. HB Global is a holding company for 7 businesses across the country. We are in the design build of mechanical, plumbing, and electrical components for commercial buildings, and also in the service of commercial and residential HVAC and plumbing systems. Over the past 10 years, we've grown from a $30 million business in Harrisburg, Pennsylvania, to a now international business, which will do over $400 million in revenue next year. Much of that was due to M&A activity. And I've been in this role for 2 years now, but prior to HB, I was an M&A attorney at a law firm in Harrisburg, McNeese Walls North.
Awesome. Thanks, Sal. And last but not least, Ryan.
Thanks, Rich, and good morning, everybody. Ryan Hurst. I'm a partner at RKL. RKL is a regional CPA and consulting firm located in South Central and Eastern Pennsylvania. My role is the leader of the transaction advisory services practice, which means that I'm doing a mix of M&A advisory, financial due diligence, quality of earnings, those types of things, as well as helping our clients through the financing process. So I'm the advisor on the panel and can speak more in terms of what my clients are up to, more so than what we're up to as a firm.
Thanks, Ryan. That really rounds out, and it's going to give us some really good context for this conversation. And one of the things we wanted to highlight as we had put this panel together is the ownership structures of each of your companies, as they're all different from one another. We have one that's ESOP owned, we have one that's predominantly private equity owned, and one that historically had been independently owned. So want to talk about how that might impact the way that you go about your acquisition strategy. So with that, maybe we'll start with the private equity owned entity and kick that over to Steve. How is that private equity ownership combined with your management team developing your acquisition strategies?
Yeah, sure. So historically, we started out as a small family-run business in Camp Hill, Pennsylvania, and ran various gyms for multiple decades. And in 2015, kicked off a strategic brokerage process where we engaged with multiple private equity firms to help us take our business to the next level. And we were fortunate to partner on April 1st of 2016 with Argonne Capital Partners, based in Atlanta, Georgia. They really focus on family-owned small businesses, franchise businesses, primarily had previously played in the restaurant field with IHOP, Applebee's, On the Border, Sonny's Barbecue, but now have stretched into some more services with Planet Fitness, John Deere, and recently Showgrounds Maintenance. So definitely have diversified their portfolio. Really with our structure, we were able to maintain a minority stake in the business going forward, starting in 2016. And from that time frame, we've done 5 different M&A acquisitions, varying in size from 1 to 24. In 2019, we acquired over 25 locations in the city of Philadelphia, as well as a 12-unit operator in Greensboro, North Carolina. So they've really helped sophisticate our mergers and acquisitions strategy. Historically, we would have never looked at buying another Planet Fitness franchisee as a small family-owned operation. With a private equity group, they've really helped sophisticate how we do our diligence, how we underwrite our business, and those acquisition opportunities, and really have helped accelerate our growth from 10 units in 2016 to 78 and growing here today.
Thanks, Steve. That's a tremendous story and incredible growth there.
Yeah, I've had to learn on the fly a lot here in the last 3.5 years. When I took over as CEO, we had 12 locations. We're just kicking off a discussion around an acquisition, and it really just accelerated from there. So I've earned my stripes on the fly, and it's the best way to learn, especially in this business.
Well, and in the business, you started at the ground floor too, at the family, and knowing exactly how to clean the toilets, to managing the gym, to now building and expanding the business.
I mastered the toilets, so we're good there, and I have no problem doing that if needed.
Thanks, Steve. Sal, why don't we kick it over to you? The ESOP ownership structure, whether or not that impacts your decisions.
Sure. So interestingly, we didn't start off with the long-term goal of executing on an acquisition strategy. We kind of fell into it. And I would say the one thing about an ESOP structure that has helped us with our M&A strategy is allowing us to use more of our free cash flow to pursue acquisitions as opposed to paying income tax, because that is the one major benefit of being ESOP owned. But we're largely in the HVAC construction and service business. So for us, what we found is it's a very fragmented industry, so ripe for a roll-up strategy. But B, to date, and Steve, cover your ears, the private equity players and institutional investors have largely stayed away from this space, which has allowed us to really grow in a value-add method. Although we have been seeing lately, as the markets are flush with excess capital, we're starting to see private equity nip at our heels and increase multiples. But for the most part, because construction is still considered somewhat cyclical, private equity and institutional money stays away. And as an ESOP-owned company, we can fly under the radar and get deals at very attractive multiples.
Thanks, Sal. I know there are probably a lot of folks that are watching this panel that might be curious maybe around that ESOP structure and the tax implications. Can you maybe just expand a little bit on how that benefits you a little bit more?
Sure. So really an ESOP is a creation of the Internal Revenue Code. So it's an IRS classification, but once you do qualify as an ESOP, you do not pay taxes, assuming you're an S Corp and structured properly. You do not pay tax at the corporate level. So we're able to have excess free cash flow that many companies as an S Corp would be using to pay tax distributions to ownership. We instead get to use that to execute on our acquisition strategy.
Thanks, Sal. Sorry, mute button issues here. I apologize. Moving on, Phil, if you don't mind, please.
We are more of the privately owned, single owner founded the business many years ago and has grown it rapidly. We are in the residential construction industry, strictly R&R, so only remodeling and only in the windows, bath, and door space. So we sort of stay very focused in what we do and just try to grow in those verticals, which are really large verticals in the United States. Those three verticals are estimated to be somewhere around $35 to $40 billion of economic activity occurs in those three spaces inside the home every year. So similar to what Sal denoted, our company went on the path of mergers and acquisitions really by accident. When the owner was approached by some other owners who said, hey, we see you're growing your company and you developed some cool technology as we understand it. Would you like to buy our company? And that's kind of how we got into M&A. And now that process has evolved over the past few years to maybe, sort of a hybrid of maybe where the folks at Planet Fitness are at, where we are now starting to be very formal about that process. We have a director of merger and acquisition, and we have scorecards and methodologies and, really just looking at it from a scientific approach. So probably structuring it, a lot more formally, even though, we're still a privately held company that is majority owned by our shareholders. So I don't think it really would change anything if we were, owned differently. I think we're just seeing the market is like Sal said, very fragmented in our space as well. And we believe, with having the right platform, that makes it ripe for consolidation. And, we want to obviously be that consolidator of choice.
Thanks, Phil. And Ryan, maybe you can educate us on all the experiences you had with your clients and how that may all tie together.
Sure. I mean, we see a whole variety. A lot of our clients tend to be pretty closely held businesses, which are private equity backed, some of which are not. It certainly opens up possibilities when there's private equity there that's looking to growth and looking for growth, putting money to work. But our traditional clients that are independently owned, multi-generational, oftentimes businesses, they tend to oftentimes go the very traditional route at this point with bank financing. It's been tried and true, tested. They know it, they understand it, and it's served them well over the years. But as they continue to grow, and as it can get more challenging to get to that degree of size, sometimes they have to look for alternatives then and seek out non-bank lenders, private equity as a form of growth capital, whole bunch of different options there. And just to chime in on our firm front, ours is a little bit different as many firms are. We will do acquisitions from time to time, and it's extra interesting with 50 partners when you're basically get a capital call and put in however much money to support the deal. Very different financing structure on that as well. Probably not too many folks facing that today, but it's another thing that we see out in the marketplace from time to time, and we certainly experience ourselves.
Well, thanks, Ryan. And the title of this panel is obviously how capital sources impact those strategies that you've just outlined. Ryan, you briefly touched on senior debt, and we've got private equity involvement here, and there are all other alternative forms of capital. So, that segue in would be, how do each of you individually or your firms finance those acquisitions? So, Sal, if we don't mind, we'll start with you.
Sure. So, well, Rich, we're lucky enough to have some great banking partners, present company excluded. No, But for the most part, yeah, we're very lucky to work with S&T Bank and Rich's company. And I would say I was just recently reminiscing. I mean, back when we started our M&A strategy, 2013 to 17. I mean, we were interviewing dozens of banks at a time up and down the eastern seaboard looking for support and couldn't find it. And now we're at a point, having shown some success over the past 7 years, where we have banks fighting to get in our bank group, which is nice. But certainly we've seen the past 24 months or longer a low interest rate environment. So we're borrowing as much money as we can to finance these deals. As I mentioned, because we're able to get deals for between 3 and 4 times trailing 12-month EBITDA, that we're able to maintain our targeted coverage ratios and still borrow money to make these deals work.
So would it be safe to say then you typically use your bank financing for those acquisitions, or is it a combination of bank, cash, or other? How do you typically finance them? Maybe a couple of recent transactions you've gone through?
So we ironically, we closed the largest acquisition in our company history this month, and for the first time didn't use any bank debt for it. So largely, we now have a strong balance sheet. We paid mostly cash, and about 2/3 cash, 1/3 rollover equity, and there is a post-closing earnout as part of that. Typically, though, Rich, I'd say the past 3 or 4 prior to this were mostly bank financing with a small earnout and/or rollover equity component.
Thanks, Al. Extremely helpful. Phil, why don't we move on to you in context of West Shore Homes, please?
Sure. So yeah, much like Sal, we use traditional bank financing. Generally, that is our preferred structure. We will try to finance as much of that purchase price as we can. Our business also has great free cash flow, so that allows us to delever the debt very quickly, which is obviously attractive to our lending partners, of which S&T is one of those partners as well. So appreciate their support of our business. We've been very active over the past year and closed a handful of transactions. Really it's putting together a good bank group and having a good structure, getting a delayed draw term note in place. So you've got the flexibility when you're doing a true roll-up acquisition strategy. So you're not raising capital incrementally as you're trying to complete these transactions. The transactions are complex enough as it is when you're negotiating with the owners and getting all the legal documents together. If you bring a massive bank financing into the middle of that could then blow up the deal. So the best way to do it for companies that have the size and capability, I'll just kind of throw numbers out there. You're probably looking to be in that kind of $5 to $10 million EBITDA range. Is sort of the minimum standard before you're going to get banks to kind of pre-approve you to move forward. Obviously, the more EBITDA, the better chance you have of that. If you're a smaller size company, you will unfortunately have to do them one at a time. You might want to leverage something like the SBA as one example to help smaller EBITDA companies create transactions that have better cash flow. If you've got great cash flow, you might be able to just get traditional bank financing and not have to use an SBA product. If you've got great cash flow and collateral, you probably don't need the SBA. If you don't have collateral and you're a smaller EBITDA company, you might want to look into what the 7A program can provide you in doing those roll-ups. And then lastly, early on, we did and still even do today, we do leverage some kind of what I would call secondary or mezzanine type financing just to round out our capital structure. Given the high growth that we've experienced, we wanted to limit the amortization and maximize the free cash flow and sort of be in a position to pay down that debt on our terms as opposed to kind of when the amortization required it. And that flexibility of a senior junior structure has worked very well for us and allowed us to scale the business rapidly, continue that great free cash flow, and then put us in a position to be able to repay quickly. So that structure's worked very well for us.
Yeah, Phil, you touched on the delayed draw term loan having as a mechanism to do that in the structure with your senior debt providers. Other companies have acquisition lines. Can you maybe expand on what that structure does for you, how that works for those that don't typically see that or haven't been able to utilize that channel for acquisition financing?
Sure, absolutely. So, really it's fundamentally, almost think of it like a line of credit that you can borrow on throughout the year for acquisitions. The bank gives us a pre-approved criteria list. So if it falls into sort of this pre-approval, then we actually don't even need the bank's permission. We still, of course, clear it with them, but there's no due diligence. They just agree to fund it based on a closing certificate and some minor conditions. And then if it's a larger or more complex transaction, they will still very much consider funding it. They'll just want to do some due diligence before they consent to it. And then that line of credit just is available for us until we get to the end of the year. And then whatever balance is on it then terms out and becomes an amortizing term loan that we repay over, a period of time. And then, each year we have a new term note. So they're staggered over, 1, 2, and 3 year periods. And then obviously as the company continues to grow and perform, the bank is then willing to put more into that term facility. So it allows us it allows our capital to be extremely scalable. So we can grow that financing by 2 or 3x if our performance, it allows us to do that without having to go back to the market and just be constantly re-raising capital and over again. So that traditional syndicated bank credit, delayed term draw structure is really low cost of capital and really flexible and scalable capital. And that's definitely been a secret to our success of financing our acquisitions quickly and being able to move rapidly in the marketplace where we're generally buying much smaller operators than us. And so the fact that we can show up quickly with a check is very, very important to them as well. It creates certainty in the deal.
Yeah, and that varies slightly in a syndicated transaction where you may have an accordion feature to accommodate some of those, those acquisition strategies or to add on to the debt. In your case, with the delayed draw term loan, you've got that committed capacity, which comes at a cost. And maybe you could explain those differences for the benefit of the group, and then we'll move on to Steve.
Sure, you've got sort of what are referred to as the traditional commitment fees of having that, commitment capital, which are very well priced, I would say, for our structure. But yes, you have to pay a commitment fee to all the banks that participate to have that capital available. That fee varies and negotiates. It's well less than 1%. So it's not, we're not talking, really, really large amounts of money to have a lot of committed capital. And then you have sort of this concept of an accordion feature, which you haven't yet paid the commitment on, but the bank is sort of, putting you on notice that if you do well, they're prepared to bring more money into the transaction with, limited additional due diligence, and you don't have to pay that commitment fee immediately. So you sort of got sort of that uncommitted and committed capital. So again, it creates a nice blended fee structure. And, really what this syndication is about creating scalable capital. That's, really the mechanism for us. There are structures out there that maybe are more flexible, but with flexibility comes higher price. So, for right now, we value the low cost of capital that comes from the syndicated structure of a multi-bank deal versus maybe a FinCo or a related structure, a private equity debt fund, which will have even less structure to it, but will obviously be a higher cost of capital.
That was great. Thanks, Phil. And Steve, you can talk about how you all finance your acquisitions. And I know that you also have a syndicated financing.
Sure. Yeah, we do, of which S&T is a proud member, and we're appreciative of not only the participation in our current syndication, but historically dating back to the integrity days. So our relationship with the bank goes well beyond our Planet Fitness days. But yeah, we same similar scenario. We utilize a syndicated bank group for our deals. Depending on the deal size and the deal structure, whether there's any type of roll or equity, will depend on whether we'll do a capital raise, incremental debt, or some type of mezzanine function in these transactions. So very similar to what West Shore Home is doing is what we have done. We kind of dipped our toes in the water at the very onset by over-equitizing our business, which allowed us to have some more flexibility with incremental debt. The one great thing about our private equity sponsor is we are very, very cognizant of our leverage thresholds and really want to maintain a certain threshold internally that allows us the ultimate flexibility to have proper DDTLs, revolvers, lines of credit for us to be flexible and have that certainty of closing, which is one thing that I think has allowed us to capitalize on some of these non-marketed deals and with other franchisees. Is, yes, you may be able to generate a higher dollar amount, but the certainty to close diminishes at certain points. And for us, we've been able to bring that capital to the table and have been able to close successfully on 5 transactions to date.
Thanks, Steve. And Ryan, maybe you can speak to each of those structures and maybe something else that you might have seen with some of your clients.
Sure. I mean, I'd say that they've hit quite a few of them at this point. But again, I'd say that a lot of our clients are still very much using traditional debt financing. It's as Phil said, it's the cheaper form of financing typically available out there. It's everybody understands it, and maybe the flexibility isn't quite there for repeat acquisitions. Or for those serial acquirers, but that's something you kind of grow into over time. But I'd say a lot of them then too, really look at a private equity source then over time is not just being capital that's available for a liquidity event, but also capital that's available to really drive some of that growth. Certainly comes at a higher cost of capital, but there's tons of flexibility there. At least if you can bring a good deal to them, it's gonna drive their valuation. They're generally on board with that. So I'd say it's a pretty good mix, but generally weighted towards the bank financing, traditional bank financing.
Well, thanks, Ryan. That was great context. You talked about your bank deals and how you have, I guess, to some extent, covenants that may gate your ability to leverage up. I suspect you all have your own internal leverage parameters that you look and try to run by. Maybe you can real briefly speak to that. Is it the bank parameter, or is it your own internal leverage guidance that you're mindful of when making acquisition decisions? So Phil, maybe we'll start with you there.
Yeah, I would say the good news on that one is it's actually a pretty shared philosophy, meaning, what the bank looks for and how we want to run our balance sheet, I think align very well. We don't have a strong interest to run a very leveraged company. Yes, leverage increases returns on capital, but it also increases risk. So, we are fully aligned in our bank, and a goal of ours is always to, when we do lever up, to be able to use that acquisition to de-lever. And if your acquisitions aren't de-levering you, then they're probably not good acquisitions.
Thanks, Steve.
Yeah, no, we utilize that same strategy. I'm a big proponent of really paying down that debt instrument as fast as we possibly can to keep our leverage ratio within our internal guidelines, which I think, quite frankly, we probably stretch inside the bank room, but just internally we have set a limit for ourselves that we want to keep. So it gives us optionality within the business, and we're not stuck with a situation like we all run into where you can get yourself in trouble real quick. And thankfully that's been our philosophy, and we'll continue to do so. And that's, unfortunately for us, it's had us pass on deals that quite frankly got too frothy and just didn't make sense for inside the confines of how we want to operate our business and manage our balance sheet.
Thanks, Steve. And Sal, I know that your firm actually does have kind of a targeted optimally operating leverage, senior debt to EBITDA, if you will. Maybe you can speak to that and how you manage around that.
Yeah, so Rich, as you know, 2-3 years ago, we were a traditional 3-to-1, 4-to-1 targeted balance sheet, meaning 3 times senior debt and 4 times total debt. We've since been on a path to deleverage a bit, not because we got in trouble, but just because we want to be safe. And so we're now targeting 2-to-1, 3-to-1 from a senior debt and total debt. And with our latest acquisition, as I mentioned, having that in all cash got us under those
Thanks.
thresholds.
And lastly, Ryan, to tie it all up, where are you seeing your clients and how have you been advising them?
Sure. I mean, I think it's more of the same, but just to comment on Sal's last point is I think that's a big piece of it, especially in central Pennsylvania. A lot of clients tend to be very conservative So to the extent that there's cash available or that they've been saving up over time and planning for this, that's almost a preferred method in a lot of cases. And maybe that's not necessarily enough to juice the returns or anything on the deal, but if they're independently owned, if there's not a private equity sponsor to appease, that's the mentality that many grew up with. So I think it's the more conservative, the better. Cash almost in some cases tends to be a primary method, and then then bank financing, and then the more some more of the higher end, more costly types of options. So it varies from client to client, but I'd say there's still a very traditional base of client in many of the markets that we serve.
Thanks, Ryan. Well, as if you already didn't all have enough banks knocking on your door, you gave such wonderful answers. I'm sure they're going to continue to be and maybe pressure our bank out. We really, really greatly appreciate all of your ability to participate in the panel this morning, and really look forward to the next step in the Q of A. So with that, we're going to wrap up here. Go and move on to Q&A. And I just want to thank you all again for your participation this morning. We have a lot of questions, so we want to try to get quickly into this for our 10-minute limit here that we have. So the first question relates to PPP, and as you're evaluating your acquisition targets, to the extent that they do have PPP, how does that impact your purchasing decisions? Maybe we can start with Sal, and in light of that, we also have questions around deal sizes. So as you're answering these questions, maybe speak to the typical deal size that you're transacting in, please.
Sure. So our latest acquisition actually was a recipient of PPP funding. I would say three things to keep in mind. First, before closing on such an acquisition, you want to do your diligence that the recipient actually qualified for PPP, which is based on the number of employees and some other factors. And second, that they actually use the PPP for forgivable purposes. So as an extreme example, buying a Lamborghini, which we saw in a recipient in Florida, would not be a permissible use of PPP funding, but obviously payroll and W-2 wages would be. Second, given some recent SBA guidance, you need to either apply for forgiveness prior to closing or seek the consent of the SBA prior to closing. So you've got to do one of those two things. In our acquisition earlier this month, we were able to apply for forgiveness prior to closing. And third, you're going to have to escrow the entire PPP loan balance until your application is processed by your lender and the SBA. So that could be a deal hang up. Luckily, our target company had the cash on hand and they had their cash from PPP, an amount equal to it in a segregated bank account. So we were able to escrow that amount, but something to definitely keep in mind for anyone looking to do an acquisition of a company with PPP, that you're going to have to escrow that money until your application is processed.
I can speak to Rich. You'll want to look at if it's a stock purchase versus an asset purchase. There could be some differences there if you're purchasing on the stock side. You'll want some form of indemnity against the PPP. And then if it's more of an asset sale, as Sal pointed to, you'll probably escrow it. Historically, what I think is you do need to look at these new revised SBA revisions. They just recently came out, and there's some different rules around how much equity is changing hands. And, there are different rules for each, and you could need to get an SBA approval in certain cases, which could obviously really slow down a diligence timeline. If it's an asset deal, the escrow, it tends to be a common use, but just escrowing in a loan, I don't think if you were buying, say, 100% of the company, I don't know that solves the requirement around an SBA. I think there's size considerations, so you're definitely going to want to talk with your corporate counsels and have them look closely at this issue. The bottom line is you can close around these things and you can work through them, but don't just bypass it because it is a material issue.
And Steve, you may have some intel here too. Obviously, there's affiliation rules with private equity. You've recently made an acquisition. Can you speak to anything there?
Yeah, so we just executed a deal here this week actually, and very similar to what Phil and Sal alluded to. Highlighted the PPP. We're going to have the seller file here and do their application early, and then also we'll escrow it as it is an asset deal. So definitely this was a wrench that got thrown into our traditional deal structure and how we look at the deals. But it is something that you really want to be cognizant of because depending on the PPP loan size, it can be a pretty substantial liability that you're assuming if you're not careful.
Thanks, all. Ryan, moving on to you. We have a question related to tax rates and whether or not potential proposals to increase the tax rates will have an impact on acquisitions. Do you have any insight that you can add to that question, please?
Yeah, I can certainly give you some anecdotal insight. We are pretty busy on the acquisition and sale front right now within our firm. We've got a lot of clients that are both looking to sell and a number that are also looking to buy. I think the potential changes in tax code, whether it's capital gains or whether it's the general rates, I think they're all driving some of the activity. I don't think it's the only reason. I think there's a lot of other factors out there, not the least of which is the M&A window is open. While there's still some disparity in terms of valuations amongst buyers and sellers, I think that there's still an environment where folks are looking to get deals done. Tons of dry powder hanging around on the sidelines. So a lot of money to be put to work. And just from an investment return standpoint, it's tough to get a good return on investment out there in traditional investment categories. Equities have been bought up significantly over the last several months. Debt yields are low, so kind of the alternative market is where folks are looking at. And I think that's driving some of the activity out there. But the big thing is when anybody comes to me in terms of a deal and they're focused primarily on the tax consequences, I think that's obviously a very important aspect of the deals. But when we're advising them, we're saying, look, don't let the cart drive the horse right here. Make sure that especially from an acquirer standpoint, that it's a deal that makes sense for you and your business. Does it align with your overall firm growth strategy? And don't get too caught up in the tax consequences. That should be a deal sweetener, not the primary reason for doing the deal. And then with that, make sure you're working with your advisors and all that stuff, whether it's with dealing with PPP, other aspects of due diligence, the tax consequences. It's just really important to have that advisor base on your team now more than ever.
Thanks, Ryan. Sal, we've got a couple of ESOP related questions, again, hot topic along with PPP here. First question related to those, maybe a further explanation of how the ESOP structure enhances your free cash flow. And then secondly, does the ESOP make it more attractive, an ESOP, at the target being an ESOP, make it more attractive for you when you're looking at your acquisitions?
Thanks, Rich. So first, if you are an S corporation and you are 100% ESOP owned, you do not pay federal income tax. So now that's also scalable though. So let's say you are 80% ESOP owned, 20% privately owned. The ESOP would get a K1 for 80% of the allocable income, and private ownership would get a K1 for 20%. The 20% private ownership would still pay income tax on their 20% allocation, but the ESOP would not pay income tax on their 80%. And so when I say that enhances cash flow, because typically most companies make tax distributions to ownership to pay their taxes for them. So you take cash out of the company, distribute it to ownership, and ownership uses that to satisfy their tax bill. When you don't have to pay taxes as an ESOP, you get to save that cash from the tax distribution, and for us, we can use it to execute on our acquisition strategy.
Thank you, Sal. Great answers to all of that. There was a question in regards to just typical deal sizes. I'm not sure if we actually covered that. Obviously, middle market, predominantly based companies, not public. So maybe you could just quickly speak to each of the typical deal sizes that you're acquiring for the context of the audience, please.
Yeah, we're more of a roll-up shop at West Shore. So, our typical deal sizes, somewhere between probably 5 and 15 to $20 million is, historically the deal size that we're on the acquisition side. Financing arrangements and stuff like that to execute these strategies are substantially more than that because we use a delayed draw term note. So we're looking for a pile of capital, and then we're going to allocate that across numerous acquisitions throughout the year.
Ryan, maybe some context for the types of companies and deal sizes you're advising on, and then maybe
Sure.
in addition to that, some diligence things that may have changed through COVID versus pre-COVID.
Sure. I would say for our clients, it's a pretty good mix. And we have lots of clients, West Shore included, that we're doing, helping them through, $5 million deal on up to, let's say $100 million. We've done more than that, but I'd say kind of the sweet spot for our firm is sort of between that, $5 to $10 million area on up to like the $40, $50 million area. I mean, we're not doing tons of $100+ million deals, but we get them from time to time. And then just to answer your question, Rich, about some of the due diligence aspects, I mean, I think it's more important than ever. And to keep in mind, the kind of the basics of due diligence are to try to address two things. One, to verify the seller's claims and assumptions along the way. And two, how is this business going to look once we, the buyer, owns it? How has it been run, and how are we going to run it? And really trying to get answers to those questions. I think the financial aspects are incredibly important. The big one being proof of recovery for a lot of businesses as it relates to COVID. So, you might look at TTM or a 2019 EBITDA and say, is that even valid anymore as we look forward? So, is there proof of recovery if they dipped, or alternatively, in some cases, we're seeing it where businesses, some e-commerce businesses that we've worked with are actually booming. And then it's more like answering the question, is this sustainable? Is that 30 or 40% revenue growth during COVID? Is that something that we can expect to continue or not? So we've been doing a lot of that work on the buy side and on the sell side as well, helping our clients prepare for sale.
Great, thanks, Ryan. And in terms of where banks are coming from, is we're screening deals. Historically, we could get in and look at things and turn a screening memo around internally to look at either a corporate acquisition or a private equity acquisition, whether it be new or existing for clients, in pretty quick order. And I think what we're seeing on the banking side is that we're almost fully underwriting to those pre-screen conversations. So the amount of diligence going in on the front end from banks has increased dramatically. At least that's what we're experienced in our financial institution. I don't know if there are any other additions you wanted to add, Steve, on your side, maybe some context for the deal sizes that you guys are working with there.
Yeah, sure. So from the deal size, we're ranging anywhere between 4.5 million to north of 100 million in the 6 different transactions that we have done to date. So they all vary in different geographies and what and how we're going to integrate those into our portfolios. But we historically have done all asset deals in that size range.
Great, thanks. Well, I think we've addressed all of the questions that have been asked at this point to the panel. So I believe we're supposed to be moving into our next session, which is the breakout here.